You say the RBI won't be following the Fed, so what conditions need to be met here before we see a cut?
Yeah, so we think there are four things to watch from now until the RBI moves by Q4, which is our view, with a rate easing. The first thing is that what's the RBI's view on the neutral rate? And the deputy governor in the press conference made it clear that the RBI is likely to publish the view on the neutral rate in the bulletin, the monthly bulletin that comes out by about the third week of the month. So that is something that the markets will be watching. That's on the quantum of the rate cut. But the other three are basically on the timing, which will be contingent on the fiscal consolidation path in the early July budget and whether the spending mix from the government shifts more towards welfare spending from CapEx, given the election outcomes. The third is what the progress of the monsoon is and assessing the food inflation risks and whether supply shocks could lead to higher food inflation, especially in the second half of the year. And the last one will be the sequential momentum in core. Because core inflation right now is in the early 3% handle. We think that the core goods part of the overall core inflation basket is going to turn around in this quarter and is going to start inching higher in the second half of the year. So what kind of momentum you're seeing sequentially is something that the RBI would want to assess before they start moving with the rate easing cycle. We have our rate cut forecast for Q4, most likely in December, but really it could be a toss-up between October and December. But on an aggregate basis, we are looking at a shallow easing cycle. We only think that 50 basis points is what we will get from the RBI in terms of easing in this cycle.
Santanu, it's Rob Carnell from ING here. Can I jump in with a question? And I wonder if you felt the same way that I did after reading the RBI statement, that it was a little bit on the defensive side. And you brought up the sort of pushback against independence for sure, but there's been some criticism post the actual election results that RBI policy is hurting growth, which seems a somewhat difficult proposition against the backdrop of certainly the first quarter numbers and indeed the last couple of quarters numbers. And also that the inflation numbers, if you've talked about core inflation here, obviously a lot lower than the 4% mid-range of the target, but the RBI seems to be saying, yeah, but we can't always rely on those non-core bits dropping back below. We need to be very watchful of food price inflation. So do you feel it was sort of a bit of a pushback against some of the criticism that the tight policy that they're holding has been damaging growth?
Yeah, we thought that the governor really balanced out the dovishness from the external members. And basically, there are two things to watch here. One, the headline inflation is still around 5%. Even with core inflation in the early 3% handle, which means that food inflation still is running in the 7 or 8% region. We think that will come down in the next quarter, but that is very much driven by the base effects of last year. If you are watching Indian food inflation now, you would want to watch what happens with the monsoons in terms of the progress that it makes through the course of the next 2 months. And hence, what's the production looking like for the main crops, the cereals and some of the pulses or legumes. But apart from that, the RBI would be very aware also, in our view, that core inflation at early 3% is difficult to sustain and it would be moving higher, especially driven by core goods. And the reason is very simple. Input cost pressures from the manufacturers pass on to the consumers in India with roughly a 6-month lag by our empirical estimates. And if you see the WPI manufacturing inflation, the non-food manufacturing inflation, that bottomed out around Q4 of last year, which means that around now or in the next month or so is when we would expect core goods inflation to bottom out and start turning higher. And if you're a central bank, you would want to watch how sharp that turn is. We don't think it'll be materially high enough for the RBI to stay away from rate easing. But if you're the central bank, you would still want to watch that over the next quarter.